There are quite a few things you can do if you have a business. Quite a few things you can do before the year is over to reduce your tax proactively. And this is the conversation that we're having right now. Once the year is over, your only options are really HSA, the health savings account, and retirement contribution, which overall call for a higher cash outflow to save you money on tax. Yes, we love retirement contributions. We love maxing out retirement when you're in your highest earning years. But we also love doing other things, which can generate a lot of tax savings. So, quite a few things that for us to go through, right? This is something called the IRS Safe Harbor. Safe harbor rules allow you to do certain things so that you are in the clear with the IRS. So if you ever get audited, there's no issue with any of that, and you're allowed to do it. So we love strategies that are legit, that allow us to save money on tax. We just love those strategies. Now, most of the businesses are on a cash basis. Most small businesses. What that means, cash basis versus accrual. Cash basis means that you can deduct expenses when you've actually paid it, when cash left the account, and pick up income when cash came into the account, generally speaking. So, generally speaking, when you are on cash basis, you are allowed to prepay next year's payments for certain things like rent or car lease or whatever, and deduct them in the current year in December. So, what we what we would do, I mean, I probably wouldn't myself prepay rent for 12 months ahead unless you do that every year. But let's say next month payment, why not? I'm going to pay it a few days later, so why not pay it now and get an extra deduction? Car lease, same thing. And this is considered to be the IRS safe harbor for cash basis taxpayers. Now, also, what you can do, number two, is you can stop billing your customers, clients, or patients. Here's what I mean, if you can afford that. If you can afford to wait until the beginning of January to receive payments for some of your services, whatever that is, then you can defer some of that billing. So just not send an invoice, not prepare the invoice, and do that maybe at the very end of December or early January so that you get paid in the new year. That allows you to also work with your total income for the current year. Completely legit, 100% allowed to do that. So just keep that in mind. Now, number three is when you plan on buying something. Now, keep in mind, if you're buying equipment, there are certain rules in deducting some of those full costs of equipment if their purchases are all concentrated in the fourth quarter of the year. There's special rules to that. So, if we're talking about hundreds of thousands of dollars, you really need to consult someone to make sure that you will not be disallowed to take the Section 179 deduction if that's what you're looking for, because there are special rules on Q4 acquisitions. Now, if you're looking to buy a few more computers for your staff, or to buy that new truck for that replaces the old truck, you can do that, but make sure that it happens before the year is over. Here's what I mean. I've had situations where a client would buy the new computer, order the new computer on January 25th. It wouldn't ship until January 2nd. Now, in the US, merchants are not allowed to charge you before the item ships. So what happened for with this particular client was that the charge was on January 2nd, and so he couldn't deduct it for the prior year. So be careful with that. Now, another thing is that you know how I talk about not commingling funds. We don't like commingled funds simply because it's much harder to prove that the expense was business versus personal and all of those things. So sometimes a business is just starting out and doesn't have a credit card, for business credit card. When you have a business credit card and you charge it, let's say on December 31st, you go in and you charge the card for something for business, because it's a business card, you get a deduction for the day that you charged. However, sometimes when businesses don't have a business credit card in the beginning, usually when they grow and maybe the credit history in there isn't that great, maybe they couldn't get it or whatever, and they end up using their debit card. What happens is that what I recommend clients do in those cases is have a designated personal credit card that's only used for that business. This is usually a limited time situation. Usually they use it for maybe a year and then they get a business credit card and so move. But if you use a personal credit card, make sure it's designated so there's no personal stuff on it. And when you use it for the business, the problem is that in order for you to get the deduction for the current year, not only do you have to charge it, swipe it, or use chip or whatever that is, you also have to pay off the balance. So if you pay off the balance before the year is over, you will get a deduction for the current year. But if you don't, then it goes into the next year. So that's one important intricacy of using personal cards for business as you prepare for the year-end tax year close. If you were looking to, if you lease a business property, if you lease an office or warehouse or whatever, before the year is over, you can do some improvements. You can improve the property. You can install a new chandelier or new lighting system or whatever. Now, typically, some of these improvements can be deductible immediately. So you could potentially, for certain things, deduct improvements to leasehold property immediately in the current year, which is very lucrative because you've spent the money, you want the deduction. Makes sense. But make sure that all of it is completed and also paid before the year is over if you're on a cash basis. And then finally, a small thing that you should keep in mind is donations, right? If you're doing cleanouts at the end of the year, if you're looking at giving away some of the things, maybe clothing, maybe office supplies, maybe equipment, whatever, make sure that it happens before the end of the year. If you are thinking of making a donation to an organization, make sure it happens before the end of the year. And then you can deduct it and actually take a benefit because the benefits are there, but again, you have to be proactive. Now, a couple of extra things that I wanted to share with you. There's something called a pass-through entity tax. This is a tax created by certain states. Many states have it incorporated that allow you to pay the tax on the entity level and then get a credit on your personal tax return. The reason being that there is now a $10,000 limit on property tax plus your state income tax. And usually in high income states and even in medium income states, that number easily crosses $10,000. So in order to kind of go around that, the states created this pass-through entity tax, which again, to benefit from, you have to make a payment before the year is over. So you have to estimate your income enough with enough accuracy so that you can make a proper payment, not overpay, not try to underpay, so that you can make a deduction and save yourself some federal tax. Very important. Another thing I wanted to mention is that every business expense needs to meet a reasonableness test. What's reasonable for one business will not be reasonable for another. I mean, think of it this way. Every business return, even if it's a Schedule C or an S Corp or a partnership return or a C Corp, has what's called a NAICS code, right? NAICS. This tells the government of what kind of business this is. And typically, there are benchmarks for different NAICS codes at the IRS, which they compare your business to, which doesn't mean it's a bad thing. Again, if you watch my video on the audits, you will see that I'm talking about that sometimes it gets manually reviewed and that's it. No, you don't even know that it's happening, that you've been audited, so to speak. So a reasonableness test, a good example is this. For a model, um, hair care, potentially makeup would be reasonable because that's a part of her image that makes her the money. For an accountant, it's not. Similarly, every other expense can be tested to that particular business from a reasonableness lens. Okay? Does it make sense? Good. And then what's important also is to know the paper trail and money trail to have that back up your deductions. Remember, I mentioned downloading your bank statements, your credit card statements, keeping some of the invoices and receipts. Extremely important. Um, that all constitute paper trail, and then money trail just shows the money transfers, right? Because when you go through audits, you will submit your bank statements and things like that. So that's why we're talking about it. And when you think about Peloton, let's say, for example, or other sports things, if you have a gym in your office, for example, some of those things can be made deductible. Travel, same thing. There are special rules when you go to travel for work, but also take your family with you. There are special rules on that. Home office and other stuff we'll cover in other videos, but I wanted to give you to kind of get your gears turning a little bit so that you can start thinking about how do you make what you have deductible, or at least some of it deductible. Okay. And this is basically what the thought process we go through for our clients every year to make sure that we are proactive in reducing their tax and lowering their liability and legally, and we make sure that there is always paper trail and money trail in place. And that's what year end moves to lower your tax bill are all about.